GDP, or gross domestic product, is a measure of our economic activity. Wages, unemployment, and jobs create a measure of our labor market. Inflation is a measure of overall supply versus demand, while inventory and mortgage applications are a measure of our housing market. And interest rates, well, they are a measure of certainty. And 2023 has been anything but certain. By the hair of our chinny chin chin, the debt ceiling crisis was averted, when in reality the U.S. government doesn't default. The political rivalry that took us to the edge created a bead of sweat on the forehead of both the equities and stock markets. Mortgage rates broke 7% again this month, touching 7.14, and mortgage purchase applications dropped 4 weeks in a row as buyers sat on the sidelines waiting for some sign of stability. Sellers were also waiting. Locked in with incredibly low interest rates and high equity positions, their desire to sell has waned. While new listings were up in DMAR's 11 counties by 9% over April, they were 24% lower than they were May of 2022. We also saw a 13% pop in active listings, but still 41% lower than we were in 2019. Consider this. Denver Metro has 3.3 million people and 1.6 million households. With 5,228 homes for sale, there's only one home available for every 313 households. Real estate is not dire, but it is strained. Some sellers are crushing it with 40-plus showings, 11-plus offers, and well over asking. Some buyers are finding the deal of the year in a slower neighborhood or unperfect home. And some real estate agents are finding their niche and seem to have all the deals. After the last few years of abundance for everyone, today's uncertainty requires the ability to break through fear. We've closed 17,164 homes so far this year. That's 2,500 to 6,500 less than any of the last 4 years. So it's slow. Yet there were 4,167 sales in May, which is up 7% from last month. So buyers are indeed buying. So let's double click on the economics of our buyers for a hot minute. Overall confidence is down, which impacts spending. Consumer confidence, which is a measure of the overall economy and job strength, slipped to a 6-month low, as did consumer sentiment, which more closely measures household confidence and how their wallet feels. Both of these, though, were measured as the debt ceiling debate ensued. And note that during the same time period, spending was up 0.8%. ADP payrolls just came out and they rose 278,000 jobs, well ahead of expectations. The non-farm payrolls jumped by 339,000 jobs, well over the 190,000 expected. Wages for job stayers increased 6.5% year over year, and for job changers, 12.1%. This is 1% less than it was last month, but it's still incredibly strong. Despite continued layoffs and an unemployment rate jumping from 3.4 to 3.7, the initial jobless claims 4-week moving average dropped 2,500. Job seekers are finding renewed stable employment. So even as higher interest rates reduce affordability, there is ability. What we are lacking is desire due to uncertainty. So what happens when certainty returns? This uncertainty will continue into and through a recession. The GDP has been dropping from a growth of 3.2% in the third quarter 2022 down to 2.6% in the fourth quarter, then 1.3% in the first quarter 2023. This slowdown of economic activity will continue to put pressure on sticky inflation. Although May 10 CPI inflation numbers did not give us what we wanted, June 13th numbers should start to show what the wholesale inflation, or the producer's price index, is already showing, as it fell to 2.3% last month. Lower inflation outside of a debt ceiling uncertainty will positively impact our interest rates, allowing yields to drop and affordability to improve. With unemployment jumping 0.3%, an economic recession is coming and will be good for housing. Bottom line, we want a recession. We want spending to slow down just enough for overall supply to balance and prices to moderate. We want jobs to remain strong and consumer confidence to regain its loss from last month. Yet, within the uncertainty today, we gain our advantage. We increase market share and take advantage of opportunity. We become thought and market leaders because when certainty returns and rates drop, pent-up buyer demand will gobble up limited housing inventory, pushing up home prices that have already begun their ascent. Well, that's a wrap. Until next time, this is Nicole Rueth with the Rueth Team. It's my pleasure to keep you updated. And oh yeah, almost forgot, go Nuggets.